Announces tonight whether it will increase interest rates for the first time since 2006. The anticipation has resulted in the rand falling all year long in value, and this weakness has made it even more expensive for government to service its foreign debt. Meanwhile, the economy continues to weaken and government's debt burden looks like it will only get worse.
The government's ability to pay its debts depends largely on its ability to collect taxes. But those it collects from are in bad shape and seem to be headed for worse. Liquidations and insolvencies in South Africa are dropping, and it seems to be good news. But analysts warn it is the quiet before the storm.
Liquidation is very much a lag indicator. It's basically almost as if the liquidators are those who move in after the battle is lost and bayonet the wounded. So liquidations may currently be stable, but I'm sorry to say that that's the best we can hope for. Unfortunately, the social fallout from the tough economic times that we are currently seeing have yet to come and visit us.
Consumer confidence is at the bottom of a long decline, and total consumption reflects this. And the rising CCMA caseload shows that unemployment is rising. This means that even though net household wealth has risen over the past 5 years and debt servicing costs have fallen, there is trouble ahead. Kevin Lings of Stanlip says that unemployment and rising inflation has put consumers under so much pressure that a consumer recession is on the cards. And recent GDP data suggests that there is no significant rise in job creation on the cards. The latest set of earnings reported by JSE-listed companies show good growth on average, but revenue growth looked sluggish in most cases, and profits were driven by foreign currency gains and cost-cutting. Companies are taxed, and if consumer health does not improve, these companies end up paying even less tax. The only chance is for companies to export their way out of trouble. The latest trade balance showed a deficit, though, after China, which takes 40% of our exports, collapsed in a heap. All this adds up to a shrinking tax base, so the government will be forced to borrow in order to spend. But the country's debt burden is already high after rising steadily over the past few years.
Government has a bit of a problem in that we're seeing a slowing in the rate of growth of expansion of the economy. And in fact, just look at the last quarter. It wasn't an expansion, it was a contraction. What that means, if there's less economic activity, there will be less volumes put through by the business sector. There will be less profit being made, less tax being made on lower profits. And therefore, quite simply, it means that that's going to put a pressure on the government's budget deficit. And I think this is going to be a problem to them. They may be facing the difficulty of having fixed debt to service, but against that, having a limited revenue with which they can service it.
Credit ratings agencies have warned this week that the country's rating is at risk. This means the government must find more money urgently. They can either increase taxes or cut spending, and neither is good for the economy. Gunther Deutsch, SABC News.